Hello everyone, my name is Nathan Winklepleck. I'm a full-time research analyst and a full-time father of four. I'm also the author of the book Dividend Growth Machine. Speaking of four kids, I have a giant scratch on my forehead and down here on my chin. I was playing with my 3-year-old daughter and we were playing cat, and she was a violent cat apparently and scratched my face. So sorry to have the gigantic scratch. But anyways, in today's video, we are going to examine a financial ratio that I think if you are picking individual stocks, this is definitely a ratio to add to your arsenal. In the second part of the video, I'm going to share with you the back-tested results, which are quite impressive indeed. The first part of the video, we're going to look into the research paper itself, talk about exactly the underlying logic behind this ratio, what the ratio is, and the author's study back in 2011, which is when this research paper was published, December 2011. The researcher was Robert Novi Marks from the University of Rochester. The paper is called The Other Side of Value, the Gross Profitability Premium. This is the formula that Novi Marks used. It is gross profits, which is one of the top lines on the income statement. It's simply revenue minus the cost of goods sold. That equals gross profits. Gross profits divided by total assets of the firm. And if you're not sure how to calculate this or don't know where to get the data, I actually have the data already calculated for you. I'll share that with you at the end of the video. If you break it down further into a DuPont analysis, gross profit over assets is sales divided by assets, or asset turnover multiplied by gross margin. This is very powerful because typically firms will have one or the other. So for example, if you're a jeweler and you're selling diamond rings, you're not going to have a ton of sales, but the sales that you do have are going to come with a pretty high margin. So like Tiffany's, for example, high gross margins, but generally very low sales relative to assets. If you look at a company like Costco, they're going to have extremely low gross margins, tons of sales, very low profit per sale, but the sales are so much relative to their assets that it will make this ratio high. So that's why this is such a strong metric, because it doesn't matter how the company is making money so long as it is relative to its asset base. Mark says in the paper that gross profits are the cleanest accounting measure of true economic profitability. The farther down the income statement you go, the more polluted profitability measures become. Using data from July of 1963 to December 2010, he ran a cross-sectional regression and found that using the gross profits to asset was more than 1.5 times as powerful as value investing, which has been widely documented in tons of academic research. This is significantly more powerful than that, and more than 2.5 times as powerful as momentum, which I'm also a fan of. He goes on to talk about free cash flows having some power, although less than gross profits, and earnings, which is what everyone focuses on. It's what Wall Street is obsessed with. He finds that they convey little information regarding future stock performance. He also found that the combination of gross profitability and value metrics diversified investor portfolios, so you got the advantage of both metrics while also minimizing risk. Also important for coffee can investors like myself, we want this to work over very long periods of time, and he found that the gross outperformance actually increased the longer you held the portfolio. So 60 months after portfolio formation based on gross profit to assets, the portfolio had an average of 14% cumulative returns over the benchmark. And as always, this is all in the past. Not necessarily a guarantee of future returns, but my own backtest of this ratio showed very promising results. I get asked all the time how I run these backtests. I always use Portfolio 123. I found that it is the lowest cost, most powerful, simplest way to get backtested performance on individual stocks and ETFs. I'll put a link in the description down below if you're interested in signing up. It starts with a free trial, so be sure to check that out. For the first backtest, I started with the S&P 500 index, and then I ranked all the stocks by gross profitability ratio. So for example, if we go back to 2004, we look at all the stocks that did exist at the time, including those that have gone out of business, and we rank them number 1, 2, 3, 4, 5, all the way down to 500. And then we take the top 75%, which would be about 125 stocks. Those represent the portfolio in 2004. And then as time goes on, we continue to rebalance this portfolio, always buying the top 125. The portfolio constructed on this ratio returned 12.29% annually from 2004 to 2024, compared with 10.6% for the total stock market index. But most importantly, it also dramatically reduced your maximum drawdown. So these are higher quality, more profitable companies. So when you get in a recession, they're likely to hold up better. So you can see the Sharpe ratio at 0.71 and the Sortino at 0.95 suggest better risk-adjusted performance. In the paper, Marx also talks about using the industry relative gross profitability to improve your results even further. According to his research, industry adjusting gross profitability reduced the volatility of the associated factor while increasing its average returns. So in the second test, I did what Novi Marx suggested, and I looked at, instead of the entire universe, I just looked at how does this stock compare with its underlying sector. So for example, if we have, say, 100 tech stocks in the S&P 500, we're going to take the top 25 sorted top to bottom, 1, 2, 3, 4, all the way to 100. And let's say we have 10 utility stocks. We're also going to take the top 25%, or 2.5, basically 2 to 3, out of this sector. However, unlike what Novi Marx found, when I simulated this result, the returns got worse. Annualized returns were lower, maximum drawdown was higher, and risk-adjusted performance was worse. So my third test, I tried the exact same thing, only this time, instead of using the 11 GICS sectors like tech, I broke that down to subsectors. So within tech, there is software, there is hardware. So let's say we have 100 tech stocks, but we have 25 or 20 software companies and 10 hardware companies. We're going to take the top 25% or top 5 out of software, and then top 2 to 3 out of hardware. And this result was a little better than the sector level backtest, but it was still worse than the entire S&P 500. So in my final test, I did a combination. I took stocks that scored the top 25 percentile out of the entire market and also had above average gross profitability relative to their sector and subsector. By filtering out the below average sector and subsector, the results improved on annualized return, maximum drawdown, and significantly on Sharpe and Sortino risk-adjusted ratios. So according to Novi Marx's research and my own backtesting in more recent years, it appears that gross profitability is a fantastic way to screen for stock ideas. As of November 27, 2024, there were 101 stocks that passed this screener. I ran each of these 100 stocks through my coffee can scorecard methodology, which gives each stock a score between 0 and 100 based on 17 of my favorite metrics for evaluating coffee can investments. Gross profitability is one of those 17 metrics. There were 3 stocks that tied with an overall score of 91. The first was Applied Materials, ticker symbol AMAT. This is a technology company, and you can see its earnings per share and dividends relative to its stock price. And this is how it scores on all 17 metrics. So for example, one of the metrics that I like to use is shareholder yield. This combines both dividend yield and buybacks or dilution. So if shareholder yield is positive, meaning that it's net returning cash to shareholders, it gets 2 points. If not, it gets 0 points. We also have dividend payout ratio. So if this ratio is less than 60, it gets 2 points. If above 80, it gets 0 points. And if between 60 and 80, it gets 1 point. But we can see the gross profitability ratio right here is 37.5%, which gets 2 points. Anything over 30, I consider to be excellent. Also tied for first place is one of my favorite companies ever, and that is Cintas Corporation, ticker CTAS. It also gets an overall score of 91. And you can see its earnings and dividends over time. And we can look at its gross profitability ratio is a staggering 51.1%. So anything over 30 is great. That is excellent. That might be one of the highest I've ever seen. And then the third stock tied for first is a company called Lam Research Corp, ticker symbol LRCX. This is a semiconductor company, and you can see its earnings and dividends over time. Looks like it initiated a dividend back in 2014. And if we look down at its coffee can scorecard, we can see the gross profitability ratio here at 37.6. There are actually 4 stocks, not 3 stocks, that were tied for first overall. The fourth is Sherwin-Williams Paint Company. It's increased its dividend for over 25 years, extremely consistent earnings and profitability through time. You can also see consistent growth in the stock's price. Looking down to its gross profitability ratio, 46.9%. I'll post the entire PDF packet with the entire list of 101 stocks over on Patreon. And for YouTube members, I did the same coffee can scorecard packet for all 66 dividend aristocrats, ranking them from top to bottom on those 17 metrics. So be sure to check that out. I'm going to start making these coffee can scorecards on a monthly basis, keeping them updated, probably changing the metrics around as I find new ratios to add. The idea is that this will ultimately become an easy way for me to find stock ideas and also share that with you. So shortcutting your research, identifying the ratios that are most important, most relevant, what's good, what's bad, hopefully helping you identify good coffee can investments. You get access to the monthly coffee can scorecards. So far, I've posted 2 of them. One for the Dividend Aristocrats, which are companies that have raised their dividends for 25 consecutive years. I ranked that, scoring all 66 stocks top to bottom based on those 17 metrics. In addition to the coffee can scorecard, you'll also get $394 worth of courses and how to value stocks like an investment legend. And then I'm also going to create coffee can course, which I'm not sure what to name it, but that is going to be coming in 2025. And I'll also be making that available to all supporters as well. In addition to all of this, you also get past and future member only videos. If you're interested in signing up, I'll put links in the description down below. You can also just click join if you're on YouTube, or you can come over to Patreon. Both of these will get access to the same content. If you sign up via Patreon, I'll send you the courses via email links. And if you sign up on YouTube, the courses are available as a member-only playlist. Thanks to everyone for watching the video, and I will see you in the next one.